All right, recording is live. We're good to go. The market opens here in about 7.5 minutes, and it is a Friday, which means we don't necessarily want to go balls to the wall. It's been kind of a crazy week in the market. Yesterday was bearish to flat, so there's no reason to try to anticipate anything and give the market more money. So on my screen here, you can see that I've got the same small account. We're still up for the month, but it's something that I took a hit on yesterday, and I will walk through that here in a second. So actually, before the market opens, I kind of want to get into that. So just to recap kind of what I'm doing on this account, beyond the individual trades, is I'm repeating this process here. So basically, it all fuels compound growth. It's compounding gains. That's the mechanism which allows us to grow wealth. Okay. And that is kind of initially fueled, by consistent contributions. And even if you're still making, insane dividends and you're still, using the wheel and making a ton of money, consistent contributions still help. All right. And when you get, the account gets bigger and stuff like that, there'll be other kinds of contributions we can make as well. So it's not just going to be for, growing the portfolio specifically, but growing finances outside of the portfolio. All right. So every month for this strategy, I'm just going to use $500. I'm just going to add it into the portfolio. If you're someone who wants to do this for yourself and you don't have an extra $500, just do what you can. But the important thing is to make sure you're squared away financially first, rather than putting all your savings into this, because this money I'm leaving in here. I'm not taking this money back out unless it's the dividend stuff and I want to reinvest those immediately. So this money is not coming back out of this portfolio. So when I deposit the $500 every month, I'm going to take $350 of that, so 70%, and put that into investments immediately, as well as any dividends or extra trim profits or anything like that. That way I have a solid foundation that will continue to grow passively. And with the more dividend yields and things like that and the trim profits, that will grow faster. And then the remainder of that $500, the $150, I'm turning that into speculative allotments. So that means that since I'm on a cash account, I can use 1/3 of that per day for speculative trades, because you have to wait T plus 2 days for the cash to settle when you sell stocks, or options is 1 day. So what this gives me basically is a non-stop chain of 1/3 of the speculative amount that I can use every day for equity trades if I want to. So I'm also allowing myself a one-time per month high-risk trade on SPX or SPY. I'm not going to do it every day. I'm not going to do it, once a week. It's once per month. And the reason for that is because I want to put the full $50 in there, so 1/3 of the speculative amount. I can put that into SPX or SPY. Every other month, I want to rotate them. That way I'm not taking a loss on SPY and then re-entering it, because then I lose the tax advantage for the wash sale rule. And you might say, oh, it's only $50, but that does add up if you do it 12 times in a row, right? So with that said, yesterday, I took a $50 hit on SPX. I grabbed a contract, got busy. It was a 0 day, and then it just never moved. SPY just kind of went flat. So I just lost on that, and that's okay. It's $50. But the important part is that since it was a loss, I know that I can now not trade SPX for 30 days, and then that will not put me in the realm of the wash sale rule, which means I can use it on my taxes to claim 100% of that as a realized capital loss. Now, when I'm trading SPX or SPY, so next month I'll trade SPY one time, up to one loss, using the same position size. If I win, that's great. I can retrade it, right? Because the wash sale doesn't apply to wins. Sorry about that. It only applies to losses. So if I win, okay, and I'm making $50, or I'm sorry, I have a $50 position and I realize a profit, I could just retrade another one without violating the wash sale rule on the other one. So I'm not going to trade SPX. I can do that again and again and again, as long as I keep making profits. As soon as I take a loss, and it's going to be on that $50 position no matter what, because I don't want to keep increasing my risk exposure. I just want to use the same position size. As soon as I realize that loss, I stop. Okay. And that means that no matter what, every month, as long as assuming I take one loss and it's $50, I will always have that tax advantage rolling towards the end of the year. So I can use that to offset the profits on these wins, because these are short-term capital gains. If I'm selling within a year on these SPY trades and SPX trades, or whatever it is. It doesn't have to be these two. I'm being very aggressive, so I'm choosing these two. It could be Tesla, it could be Apple, it could be Microsoft. When I realize a profit, though, I'm responsible for roughly 37% of the realized profit for taxes, because that's just how the taxes work. But I get to claim 100% of my losses. So as long as I keep those losses rolling in, I can claim them and offset the tax burden of the profits. So that's something I'm going to go over on my next episode. But I just want to show you guys kind of what's going on behind the scenes, because that will have an impact on these live trade Friday morning streams. So does this make sense so far? I'm trying to take things beyond just the individual trades and show that even if you're not very consistent with the profits, you can still be net profitable overall and grow your account. I think there's a lot of pressure on people to try to be right all the time. And that really, really, really hurts because it's just not a realistic expectation. Yes, Wile E. Coyote, that is a good point. So, and I can't give tax advice. Like everyone's circumstances are different. Every state is different. There's state laws on top of federal laws. When it comes to a limit on those losses, there is a $3,000 cap for most individuals, right? Again, I can't give specific tax advice. For me personally, I can claim up to $3,000 in losses per year, minus any amount that is that falls under the wash sale rule. Anything that falls under the wash sale rule, you can't claim on your taxes like that. It comes in on your Schedule D. It should disclose it and say wash sale. And a wash sale, for those who don't know, is just when you sell for a loss and then you re-enter within a 30-day window to a substantially similar position, I think is the way they word it. That means you can't claim that loss on your taxes for most people. So to avoid that, I'm just rolling and limiting myself to one loss per month. And then that way I don't have to worry about the wash sale rule because I'm not touching SPY for 60 days after I take a loss, right? Because I have that whole next month with SPX and vice versa. So that's a pretty easy strategy to roll these losses. And if you think about it, let's go ahead and do the math, right? If I'm just risking $50 or, it will grow, right? 50 turns into 100, turns into 150, blah, 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 and so on and so forth. I could just choose to limit this to $50 a month and be done with it. Or I could gradually increase it knowing that my max losses can't exceed $3,000 for the year. If they do, it's okay, though, because you have the indefinite carry forward. So that means that if I realize $5,000 in losses, I can claim $3,000 this year and then $2,000 the next year. It's just kind of used until it's gone. So that's another thing that's good to know about. But again, you have to seek out the guidance of a locally licensed tax professional and not just take my word for it, because I don't know your financial circumstances and I don't know what you're eligible for. But it is good to kind of know what kind of cards you can play. All right. So if you can't figure it out on your own, it's okay to just, it might take the hit a little bit when you pay someone, CPA or something, but it's always better to have that protection. So market is now open. So let's go ahead and look and see what we got. So in this portfolio, I have KLXE, which is just a swing that we've had open for a while. It's just back around entry. If we pull it up to the 4-hour chart, we can see it's just kind of in this range, and that's okay so far. I'm just looking at these lows for them, higher lows. So far this is still valid, so I'm okay with it. It's taken a while. Same thing with 9. These two are twins, basically. They're both resistance trendline breaks, divergence setups, and then BACs off a retest. So same exact setup for both. I think I alerted them on the same day too. So they're twins. They're my twins. And then I have IOVA, which is a personal trade that I took off a day trade. So I still like this one. I did average down on it, which put the remainder of my speculative allotment for the month into this position. I plan to reduce it at 565 if we get that pullback. And if it fails this low here, I'll just cut it and take the loss on that and just work towards the next level here. But we have one more week of trading on this account before the next contribution, and then that's going to change my allotment amount. Now, that doesn't mean I'm going to put the rest of it in this position. It doesn't mean I'm going to do anything crazy. It just means that I will eventually have more speculative funds freed up. Okay, that's all that means. So it's not wise to put the rest of it in a position that's currently red just for the sake of averaging down. I did a very specific action here, and I have a specific limit to the amount that I'm willing to contribute to this specific position. So Right now, I'm a little bit over allocated, and that's okay because I have a longer term plan for these. And I'm okay with this specific stock because I do believe they have good potential for a good pop and then a hard sell off. And I don't want to be in that sell off. I do want to be in the pop, though. So to minimize that risk, as soon as it gets up here to 565, I'm just going to reduce the position. So it eliminates a good chunk of that risk exposure and frees up some of those funds. So I'm expecting that to occur pretty much any day. I don't mind having a lower position here. We'll just see what it does. But I think once we get over 620, 630, we have plenty of room to run up here into the $7 range. I'm not going to hold it for the entire time, but I will be able to scale out. I have 15 shares. So, okay. So beyond that, we have the 2 dividend stocks that I have so far. Now I have Johnson & Johnson and JEPQ, and I'm not going to dive into the rabbit hole of the rags to riches stuff here, but just know that these 2 positions are holdings for investment. They're long-term. I'm not going to be selling these unless something drastic happens. I do plan on contributing more to them, and this is the 30-minute chart, so I'm not too worried about the sell-off here. Because these are very, very long-term investments. I'm okay getting a discount if it comes down to here. So I just wanted to point that out. And I will also be adding other positions for dividends into the mix. So let's go ahead and look at everything else that everyone else wants to look at. So right here, first up, we have Tesla. I know that Ethan loves Tesla. I love Tesla. Here's the 4-hour chart. You can see here that we've failed the short-term support line. Okay. We didn't get a retest yet, so that'll be interesting to see if that happens. We could consider this a retest. So this is looks like a roughly 25% pullback after this impulse to the downside. We'll do that. Is that 25? That's a little over 25. That's pretty good. All right. So right now we can reasonably deduce that we're probably going to see a lower low here because this is typically what we see before H-shaped continuation, unless this double bottom. So we have an area of potential reversal right here. Not the right thing I was trying to draw. Trying to draw a line or a rectangle. Sorry. So what we have right here is a potential double bottom, right? It's going to push up or it's going to fail and give us H-shaped continuation. That tells us that right here is the highest risk opportunity for either direction, right? Because it has an equal chance of doing either one. Therefore, we can just not trade it right now, or we can look at the lower time frames and see what's going on here and take an effort with a very, very small risk. Now, since I don't have any free funds on this account, this cash account, because I put 2/3 of the speculative amount in here, given that it was a smaller amount, and I gave 1/3 of that to SPX yesterday in an attempt to start this cycle here. I don't have anything to trade with today. So we're still going to look at setups. We're still going to simulate trades and all that good stuff. But I really want to focus more on the trading plan aspect because if you don't have a plan, you're just kind of a victim of circumstance when it comes to your trades and your risk exposure. And we don't want to do that. So let's go ahead and review that a little bit. And I know some of you guys that are veterans here, you've been through this a lot, but it's always good to revisit the fundamentals. I'll put SPY down here too, because I know you guys love SPY. SPY in the 5-minute, always a class act. Let me erase all these drawings here. Okay, so here is the close from yesterday. I'll draw the bracket here so you guys can see that as well. You guys like that closing bracket stuff. So basically, we're going to draw that line, and then we're going to draw that line. 431.23. Okay. So this is the bracket from yesterday. We're in the bracket. It's a pretty wide bracket, so there's really going to be it's a high-risk day to trade. So there's no reason to try to force anything on SPY either. Looks like bears are probably wanting to take Tesla down. That's a lot of strength to the downside, but we could see this easily turn into a wick and then a push off the support and have a miniature double bottom with a nice wide segmented midsection, despite having that wick, obviously. So this is very, very risky. It's approaching this low right here, 254.21. I don't see Ethan in here, so he's probably watching this like a hawk. All right. SPY got its little gap to the upside with a counter candle, right? And what we know in most cases when that happens, we tend to reverse and test the bracket. But in this case, we're literally right in the middle of the bracket. So there's nothing to do here. At the moment, there's really no decision made in the market, and it's a Friday. Okay, so this is a good day to focus on developing a trading plan, having a bigger picture view for your trades, and looking at higher time frames. So let me kick this up to the 1 minute just so we can identify potential setups as they occur as I'm rambling. But right now, there's nothing that I see that's safe. Or safe enough, I should say. Nothing's really safe in the market. All right. So now that we've kind of ruled out Tesla and SPY, unless somebody wants to be like super risky, not me, but somebody could if they wanted to. Let's talk about a plan. So, so beyond this, right, you got to have a plan. And there were some really good questions that were brought up yesterday. Matster asked, for example, how do I handle swings? Okay. How do you handle the different trade types, right? And it really just boils down to which column they fall into. If you're putting $500 into your portfolio every month and you've got $350 tied up in investments, you're not going to be taking swing trades with that $350. That's already reserved for investments and long-term holds. So what you're going to do is you're going to reduce it down to this 150. Okay. And in this case, if I had 150 to trade for the month, to grow that 150 for the month, my max loss should only ever be that 150. Okay. So at the end of the month, the next time the first rolls around, I should at least have 350 in my portfolio no matter what, because that means I didn't give it up. Right. So when it comes to the different trade types, it's really just about how we break up that speculative amount. So if I have 150, right, it's not a lot. It doesn't seem like a lot. It doesn't feel like a lot, but there's still a lot we can do with it because it's all about percentages. Let me just double check that recording. Okay. Just want to make sure I'm recording. I'm always paranoid about that. Okay. Yeah. So it's all about percentages. So we typically reserve 10% of our portfolio. And when we say that, we mean our speculative trading amount for things like individual positions, right? If you're putting a third of your account into one risky position, that opens you up to a big loss, right? Sometimes it is preferred to take, fewer, bigger positions. Like I know Lee likes to do that. I like to do that, but that's because we have the experience and we're not necessarily going to hurt ourselves. If your goal is to learn and get practice and to manage your risk and to be careful while you're learning, that 10% rule or that 10% limit is designed to help you. Right? If you have the experience, if you're consistently profitable, you can consistently manage your risk, absolutely go crazy. Take 3 to 5 positions, maybe, if that's something that you prefer. Again, I can't legally tell you what to do. But if you're struggling, you're red, you're consistently taking losses, it's probably better to stick to smaller positions until you can iron out those wrinkles and find that consistent profitability. Okay. And when I say that, that doesn't mean that every single trade is going to be a winner. It just means that your wins will outweigh your losses and that you're doing things consistently and able to identify things and make progress as a trader. Okay. Even if it's the alerts. If the alerts are messing you up, slow down, ask us for help. Obviously not everything's a winner. If something is unclear, ask us for help. If you don't get the answer you like, reach out to me specifically if you want, or to Nick or Nikki. We're more than welcome to help you out, bridge the gap. Anything that you guys need, we're here to try to help you guys. All right. So if I have 10% limits on all my positions, that means I can take up to 10 positions, right? That's the easiest part of the math there. Okay. Also, it looks like Tesla fell down, broke new low. That doesn't necessarily mean it's continuation, but let's see where it closes. And let's take a look at that. We're taking a detour right now. So we have a gap here, technically, and we never got our retest here. So I'm a little bit cautious about that. But there is potential for it to come down into this zone. So let's keep an eye on that today. And again, I'm not trading anything on this account right now. So this is all just for study, right? And that's another thing we'll get into here in a little bit. But let's talk about the specifics of the trading plan. All right, so if I have 10% of my speculative trading amount for any position, it doesn't matter what type it is, any position, that means that I have a max of $15. Okay, and it might not seem like a lot, but that's where the consistent contributions came in. And if you're limited to $15 per position and you see a stock that's $12, that's one share. You're limiting your risk exposure by not putting more than that $15 limit in there. That one share, if it performs well, you've made a profit on $12. So you've only risked $12, but you've made a good percentage profit on that. And that's really what it's about. It's not making, net dollar amounts. That should take care of itself if you're focused on the percentages and being consistent. And more specifically, consistently not increasing your losses, right? By taking bigger risks and stuff and compromising and, you know, deviating from your plan. Okay, so $15 max per position. Okay, if we are on a cash account and we're day trading, okay, that's going to change it as well, because that's going to take that 150 and divide it by 3, which leaves you $50 per day. Okay, so if I want to speculatively day trade and I want to use the full speculative amount just for day trades, and I'm not interested in taking any swings other than my, you know, the dividend investments, but if I'm talking just speculative trades, that leaves me with $50 per day. Okay, so 10% of that is $5. Okay, and again, that doesn't seem like a lot, but if you're trading things that fit your trading plan, they fit your budget, they fit every criteria that you have, and you're not forcing things, you're not breaking your budget just to get into a trade, that's good, right? Because you're still going to make a percentage result, whether it's a profit or loss on that $5, up to $5. And that is going to make it so that you can make those consistent habits and the skill set build out. And then all you have to do is just understand that there are more contributions on the way, which will inevitably increase this amount, this 150, which will increase the amount that you have to trade with per day, per position, all that good stuff. And that will allow you to take more expensive trades without having to over allocate and take trades just because they're cheap or just because they're expensive, trying to overcommit to them and all that good stuff. So the dollar amount should just be a filter. As you build your portfolio up, it should just be a filter telling you what you can't over allocate into. Okay. You should always focus on the quality of the trade and the confidence that you have in the setup and what you can identify. And if you can identify it, you can identify the risk. And if the risk is small and the reward is reasonable, you've passed the test. If it fits your budget, you've passed the test. You can move on to the next criteria. Does it have, you know, volume? Do you see a confirmation? Is the company in good standing? Do they have strong financials? It depends on what kind of trade you're taking. But how do we do like a hybrid? Right? If I have $150 for the month to trade on with speculative trades, and I want to break it up into swings and day trades, okay, all I have to do is divide up that 150. So I could cut it in half. I could do 75-75, right, which would give me $7.50 per swing trade, or $2.50 per day trade, right? Every 3 days. So let's go ahead and do that. Let's say I want to do 75 for swings, 75 for day trades. All right, and then we'll add options into the mix after that. So this, sorry, right here, this right here on SPY. Let me just draw up my 20-cent bracket so I have that, because you guys know I love those. This does not fit. So this risk right here, this bullish engulf on the 5-minute on SPY, is not, it's not below that 20-cent limit, and we are still within the first half hour. So that is also a factor. I usually kick it up to 30 cents, but I just don't like this because, again, we're in the middle of the bracket. So sorry for the little detour. I just wanted to explain that really quick. Okay. So if I have $75 for swings and I'm only using 10% per swing, that gives me $7.50 per swing position. Okay. If I'm doing day trades, okay, I'm going to take that 75%, divide it by 3 to get $25 per day, which gives me $2.50 per day trade. I'm sorry, per day. Yeah, I'm sorry, per position, per day trade. I was right. I gaslit myself. Okay, so does that make sense? It's a very small dollar amount doing it this way. But then again, that is also because you are in a super small account in the grand scheme of things. $500 with 70% of that tied up in investments only leaves you $150 to speculative trade with. And that's okay, because that's how we want it. We want the bulk of our capital in the more stable, safe, slower growing passive income, and the smaller amount in our hands so that we can expose it to risk and potentially make profits, but also potentially make losses. I know which one I prefer to have the bulk of my money in, and it's not me. If I'm a new trader, that is. So, and then we just have to modify this formula a little bit, because this 150 is going to change, right? It's going to change either when we win or lose on the SPY day trade or SPX day trade that we're allowing one loss per month on, so we can get that tax advantage. Or I am anyway. I can't tell you guys what to do. Or we're going to make profits on that, at which point this number will get bigger, which means this number gets bigger, which means this number gets bigger, these get bigger, this gets bigger, and this gets bigger, right? And at any point when we're making those wins, we can stop. But the important part is that if you're, for example, with that SPY or SPX trade, if you're using a specific position size of, let's say, max $50, and you're only ever exposing $50, and say after the first trade you walk away with $60, the second trade you walk away with $75, the third trade you walk away with $0. Let's say it just got away from you and you went down to zero. You still get the tax advantage for that loss as long as you don't re-enter within 30 days. In most cases, you still get those profits that you can reinvest, and that capital gains offsets by the losses. So you should be in a good position. But more importantly, your net P&L should be positive because you have, I'm sorry, for the overall schematic, should be net positive because of that tax advantage. Sorry. And the fact that you limited your risk to only that $50 initial position every single time you took that trade. So rather than, trying to compound the speculative amounts sequentially, right? If you're doing those high risk trades, if you're trading something safer, you can absolutely increase with those consecutive wins. But that's if you can manage your risk and you're guaranteed yourself that you can be safe on those, or relatively safe. If it's a slower trade, maybe an option swing or something like that, that's when you want to increase those position sizes as your speculative amount grows. But if you are just trading like SPY or SPX and you're just trading those until you lose, you really want to just keep that position size flat, because that's how you hurt yourself, right? You grow your account really, really crazy, and then you give it all back in one trade. So don't do that because it hurts. But again, I keep giving command verbs like do this, don't do that. I can't tell you that. So I wouldn't do it personally. All right. So with that said, does this all make sense to everybody so far? Does everyone kind of see the big picture view and the importance of having a plan and having specific numbers in place? Duco puts his hands up. That's good. I like it. Does breaking up the speculative amount per trade type make sense? And then breaking up the subsequent leftovers for your day trades and stuff? Yeah, Devastator, I can do that for sure. Give me just 1 second. I just want to make sure we don't have any anyone who's not who might have questions or something like that before we move on to the next topic. Okay, definitely helps. Okay, good. That's what I'm here for. And all we're doing realistically is we're breaking up our risk exposure. There's a hierarchy here. We're doing it automatically just by building out this plan, because if you're trading day trades, given the higher risk nature of them, if you're only risking $250 per day trade or some smaller amount of your portfolio, you're automatically managing risk on higher risk trades. So the risk goes up, the position size goes down, right? And then when you're putting 70% of your capital in dividend investments, wheel strategy, passive income, that's more stable, more safe, those positions are bigger. So you're automatically increasing your position size with the lower risk stuff. So there's a proportion there, right? And that's what I'm really getting at here. So just by breaking it up like that, you're already building risk management into your trading plan before you even touch a trade. I haven't touched anything yet other than what I have here. But if I was a brand new trader coming up with this plan, I haven't done any work yet in the market. I haven't exposed anything to risk other than a little bit of time, but I've already figured out that I can put $350 into investments, and I can break up $750 for swings. I can do $250 for day trades, and that's automatically respecting that hierarchy of risk exposure. So if I suck at day trading, for example, I'm only taking those risks on $2.50. Okay. If I'm looking at the higher time frames and they're more stable, I'm risking 3 times that amount just by not having that as part of the 1/3 rule. Right. So this is where I should see the more stable profits. This is where I should see the higher risk, lower returns. I don't mean lower returns overall. I just mean there's less profit dollar wise. Same percentages, higher percentages. It's all good stuff. But this is where I should see the bulk of my profits with the active trades. right? And eventually the dividend stuff will catch up and it'll outperform this stuff as long as you're not like over committing to your trades. And then it'll allow you to feel good about taking like a 2% profit. I'm sorry, 3% profit on the bigger, the bigger tickers. You can actually trade the equities and make pretty good profits on that once you've got bigger allotments. You just have to get to that point without taking crazy risks. Like no one's going to turn $1,000 into $10,000 in a month unless they're taking crazy risks. So don't do that to yourself, because everyone that you see that has done it, there's probably 1,000 that couldn't and they washed out. So we're going to do things the way that the institutions do them and the way that the people who have studied and made it successfully and made it systematic are doing it. We're not going to gamble and hope we make it, right? Duco, I'm in and out of my truck working at the moment. I'll be watching this recording tonight. If you have questions, okay, yeah, definitely reach out, man. My DMs are always open. If for some reason somebody does DM me and I don't see it, feel free to just harass me in a chat or tag me or something. I try to check on it, but Discord likes to hide my DMs a lot of times. So sometimes they don't even show up in the message requests. So I want to make sure that I don't miss anything. Okay. So we can see here, SPY is just kind of doing its thing, right? Still just in the channel. Tesla's retesting that level, which is kind of what I was expecting to happen, because we didn't really have any resolution. It just pushed through and then we got some wicks. So nothing really spectacular there yet, but this is decision time. If it pushes down here, that's a retest and a confirmation to the downside. At that point, we just look for those nice, tiny engulfing entries, or those engulfing confirmations, and then we could have a pretty sweet ride here. Otherwise, if it's not, as Ethan says, an A+ setup, we don't need to trade it, right? So in this case, we're just seeing an impulse and a retrace. So let's look at the impulse here. And I know I'm kind of all over the place. I promise I will get to that BAC strategy in 2 seconds. So this is the 50 to 61.8% range. Yeah, I'm drawing the wrong tools here. The keyboard is off to the side, so I'm trying not to mess those up. All right, so this is the retrace zone. Let's see if we get a rejection out of that. Price is going to compress into it in an attempt to push it up above the 61.8 and out of that box. If it rejects to the downside and confirms, we get H-shaped continuation. But ultimately, it should make a decision around this box. We're kind of in the range of it now, so I think a lot of people are probably going to be looking to get some sort of confirmation here. And again, I prefer those super tiny ones, like this right here, for example, on SPY. This is a good one. This is a good one, right? We just want to see those tiny, tiny candle bodies to the highs, and then we want to see an engulf to the downside with some aggression. In my case, anyway, that's what I prefer. So since this candle is huge, that is not a good candidate in my opinion. So I don't even have to look at this candle till it closes. And then when this candle closes, I can see how big the candle is, assess the risk, and then if we get an engulf to the downside for that bearish continuation, then that's an opportunity, right? Because we have defined risk, defined entry. It's nice and small. The profit side is bigger, and then we can decide whether or not we want to trade it, and then we can default to position size, see if we can afford it. If we can't, we pass on it, right? And just because we can't afford it doesn't mean we can't trade it, quote unquote. We can still get the practice and the experience by paper trading it or just marking it on the chart. So if there's stuff you can't afford, it's okay. You can still use that and still get value out of it. You just can't get any cash from it. That's all. Okay. So with all that said, let's talk about the BAC strategy. So the BAC stands for big ass candle. And all that means is basically we're just looking to see where these giant candle bars are in the price action, because they indicate both bias. Like you can see these big red bars right here, right there. They indicate the directional bias, the strength. And if you see one of those off of a period, a place of value, such as a contention zone, some sort of supply and demand area, right? Which is what a moving average is. It's just a distribution mean. Then we can use those to our advantage, because we're seeing in that case, we're seeing a strong push, right? That's what the big bar represents, away from an area of contention, like right here, for example. This is a beautiful example. I just have the 20 period moving average on. I'm on the 5-minute chart. So this candle is more than 30 cents in size. Now this is on the 5-minute, so we got to look at the 2-minute, or that's what I prefer is the 2-minute. You can use whatever time frame and ticker you want, but this is an abnormally large bar. I think we can all recognize, comparing it to every other candle here, it's pretty big. Which means there are two opportunities, right? The first one is that we have an entry, an anticipation entry, as this candle is being maybe 3/4 of the way formed, right? So I'm not talking about price wise. I'm talking about once the candle is either strong enough price wise, or if the time on it has less than, just like a minute or so left on the 5-minute chart, then we can consider an anticipatory entry on a small position, right? Because it's higher risk getting in while the candle's still forming. But we also understand that we can save some more of our capital for the confirmation entry. So in this case, if we were to take this, we would have a stop loss here, right? Because it's 1 cent above the high of the candle or the moving average. In this case, it's right next to the moving average, so that's okay. We have the anticipatory entry right here. And that is one small position. The other approach here is to take a confirmation entry. So in this case, you see that the bearish candles turn into bullish candles, and then the bearish candle here fails to overtake this. So there's no engulf to the downside. So that's not a confirmation entry. What we really want to see is stuff like this, where the red candles, in this case, take over the bullish candles to the downside. And then that would be your secondary entry, more confident. And then your stop loss would be up here. But in this case, these guys, these wicks, they hit the stop loss. So this is where it becomes a little bit subjective. In this case, they didn't necessarily stop out. We weren't able to watch this in real time to see how long they were up here. But I probably wouldn't consider that a loss myself. But if you're just a diehard, like I'm going to follow the rules, which is okay because you manage your risk more effectively that way, you would have stopped out, and that's okay, right? The drawback to the BAC strategy is that the default candle size, the default risk size, is going to be at least 30 cents for SPY anyway, right? Because that's the rules. We have to wait till a candle size is of a specific amount before we can get in, or before it's considered a BAC. So two conditions have to be met. It's got to be a certain size, and it's got to be off of the moving average, up or down in that direction, okay? So in this case, we would have taken that stop loss. And then we got another BAC right here. This is a 92-cent candle. It's on the 5-minute. So, of course, use that discretion. So let's go ahead and draw these positions out. All right, let's just say we entered here. Stop loss is here plus maybe 1 cent. All right, because we want to go a little bit higher. And then we want at least a 1.5 to 1 for these. Because the risk is bigger for these, I typically stay around the 1.5 risk reward. So in this case, we would have stopped out right here for a total price range of $1.04. Right now, of course, you have to add in the differences in premium for contracts if you're trading contracts and all that good stuff. So there's really no way to do that retroactively unless we have a replay feature where we can pick the right contract, right, as we would in real time. But in this case, let's go ahead and draw this guy. Okay, let's just say we got in around the bottom, right, because we don't necessarily know when it's going to form. Stop loss is this plus 1 cent. Oops. Okay, and then we're going to set that 1.5 to 1. Boop, boop, boop. Right here, roughly. Okay, so in this case, the profit potential was over a 145 range for the first target, right? Obviously, if the stop loss is hit, we want to sell everything. First target gets hit, we can then scale out. Right, but we want to lock the majority of that profit around that first target, that 1.5 to 1. In most cases, again, everyone's different, so that we lock in the bulk of that position, okay, and secure those profits. Because when you lock in 75%, what you're doing is you're leaving that remaining 25% with not only the room that it takes to get back down to your entry, but 3 times the length of entry to that first target. Beyond that, to get to stop loss, or to where you give those profits back. So if you have a stop loss in place that's not 3 times that distance, which it shouldn't be because you're doing a 1.5 risk reward, you should, in theory, guarantee yourself net profit. So that's kind of the idea behind that. So in this case, we have, I have to turn the moving average off here. That's not the right thing because it's kind of skewing the price. But right here, we have another example, and this also falls into the engulfing territory. We have that color change. Right, we have the red candles turn into bullish candles, and then they get consumed by the red candles again in the direction that we want it to go. We also have one right here. So this could have been the more confident entry where you maybe double your position size. This one also secondary entry with a stop loss right above it. But every time you see these or isolated lower highs, you can move your stop loss as well. So in this case, our stop loss was here, and then it would have been here as soon as this candle formed and closed, and this one opened because we validated that lower high at that point. Now, in this case, this doesn't follow the 2-candle rule, but it is the highest of the bullish candles, so we can use that as well before the bulls took or the bears took back over, right? Same thing with this one. So as soon as this candle formed, we can move our stop loss down here. Or I'm sorry, I think it was this guy was the higher of the two. All right. And then we got another color change right here. So that's another entry if you missed the initial entry and or maybe you didn't feel like taking it and you just didn't catch any of these secondary entries. You can do the same thing here. As soon as this bearish candle, or this one right here, I guess, takes out this guy, that's when you can move your stop loss down or consider taking another entry. This was in the last 15 minutes of the day, though, so maybe you didn't want to do that. And you can see it goes on pretty far, right? And then price just went sideways this time. Obviously, that is after the fact. There's no way to know what's going to happen in real time. So the best we can do is follow what is rather than trying to trade what if. So in this case, we took $1.04 worth of price range loss, and then we immediately secured $1.45 price range profit. So that is net profitability as long as you choose the efficient contracts and can get filled, right? Or if you're just trading equities, that's where it's at. And then, of course, you can add more into the mix by letting it breathe on the remainder of that position or taking secondary entries and all that good stuff. So does that make sense? I kind of went through it pretty quick, but it is on the recording, and I'm more than happy to help you guys out with that a little bit more. So this isn't one, it's not one of those strategies. Oh, it's got a 100% success rate. I'm not going to BS you guys. There's no such strategy like that. But this does minimize risk and maximizes profit potential, right? Because if we compare this, if I just draw this out, let's say that we took our profits here, right? Because we have a little bit of an end of an impulse there. Let's just say that our profits ended there and we took it here right to about there, right? That's almost a 1 to 3. I'm sorry, that's a $2.97% profit exposure, right? Obviously, if you're scaling out, you're not going to get that full profit, so it's not going to be represented accurately. But the $1.04 risk exposure to a $2.97% profit exposure is pretty good, even when you're scaling out and stuff. So that's kind of where it's at for me anyway. I like doing this stuff. Plus, you get these other trade opportunities. And let's just say that you open the next day and you wanted to catch this one as well, and it went down here and it pushed up and all that good stuff. At that point, the BAC is over, right? Because it's the next day. There's no continuation of that momentum. Because remember, at the end of the day, what the BAC represents is a fight between supply and demand, the distribution. The two sides are compressing nicely together. And then the BAC kind of breaks that. It releases it. So if we visualize that, let me just do that real quick. Let's look at a wedge, for example, right? Because we all kind of know what a wedge is and how it works. So let me just draw that really quick. Let's say you got price coming in here. Boo, boo, boo. Right? Let's say you got that kind of setup. Okay. And these represent supply and demand. Tesla's in the box, by the way. So just a heads up on that. So this is going to make it or break time on Tesla. But let's get back to this wedge here. So this is supply. These are people that have shares. They want money. So they're going to sell, right? This is demand. These are people that have money and they want shares. So they're going to buy. Okay. So they push the price up by buying, and then supply says, okay, I'm going to lock some profits here, right? I'm going to start selling. Price comes back down, and then supply kicks in and says, or I'm sorry, demand kicks in and says, oh, cool, we get a discount. I want to buy some here, right? For the next leg up. They do. People sell. They push back up. People buy. They push down. They push back up, and you get this overlap, right? It's a compression. It's an over compression. And then what happens is one of these sides fails. Okay. In this case, the demand side failed and the price pushed down with violence, right? Because all those people, they don't just disappear. They turn their orders into stop losses and they change direction of their trades and all kinds of other stuff. So now you have twice as much selling pressure right here, or roughly, right? And that's what makes wedges so powerful. And the BAC is no different. right? Because you've got this compression at this supply and demand, price falls below that, and then you see a sign of bearish strength. There's people that are bullish that are going to turn into sellers, right? Because they want to exit their positions, manage their risk, and then you've got bears which are already on board, and they're just going to buy in into their short positions or puts even more aggressively, and then that's how you get those big ass candles. And then that strength doesn't just magically go away, because in theory, if everyone is at that point convinced that it's a bearish position, this entire bar should act as a resistance level in order to thwart the bullish attempts to push it back up. So in this case, it did. It gave it back by a couple cents, and that's okay, right? That's why we manage our risk. But over here, we got it again, and then everyone was just on board with it, and it just never came back. It did attempt. You can see it pushed into this box, the candle body right here, pushed into this a couple of times, and then ultimately it just failed. And then we got another big push out of that. That's another 70-cent candle right there when people just finally gave up. And then again here, and then just kept pushing. So, so that's what it represents. Hopefully that makes sense. And again, there is one drawback, and that is that in order to qualify for a BAC, it has to be a certain size, which means we have a bigger minimum risk, right? Just by default. So it's important to understand that. But if you're someone that doesn't like those anticipatory entries, we can always just look at the smaller engulfing trades that have that minimal risk. So in this case, if I'm looking for a bearish position, this candle here wasn't it, right? It didn't take over the range of the bullish candle before it. This one did, right? So this would have been another ideal entry, even though it's a little higher. The BAC is still in effect, right? But you can also pass that if you don't feel comfortable about these wicks and the fact that it pushed up here a little bit. But then we get another BAC right here, another bullish candle to engulf. So this right here was a beautiful entry opportunity. Another bullish candle right here, engulfed. I already drew a box there. So that's another opportunity right there. And then you get another one right here. And then again, that's towards the end of the day, so you can always pass on that. But that's the idea, right? Because in theory, we're below the moving average already, right? We've had multiple signs of strength below the moving average, so there's a lot of bearish presence. So why fight it, right? All we have to do is look for opportunities that have super tiny risk at that point. And these little engulfing candles with very, very tiny bodies and tiny wicks have just that. They're very small, low risk opportunities with obviously very good potential in most cases. It doesn't mean they're going to win all the time, but that's why we choose that small risk. So if you don't like those big pushes, you don't have to trade those. You can always just wait for those little color changes like this, right? See how small that is? Right there. That's beautiful. Beautiful risk. And some are going to work out, some aren't. Like this one here worked out, that one there worked out, that one there worked out. Let me just move this over here so we can actually encompass the entries. And when I say this, what I'm doing is the entry here would be 1 cent below the open of the previous candle in the direction that it's that the trend is going. And then the stop loss would be the higher of either of these two candles plus 1 cent. Because once it gives up that high, forms a new high, the setup is no longer valid. So let's just keep looking. So this right here actually is a very good example. This wick right here represents that at one point this was a red candle. You can't see it because my mouse is over it. And it is at least 1 cent below the open of this candle here, this previous candle. So this at one point was a red candle that did engulf this white candle. However, the level from here to here might be a little bit high, so we could have passed on that one. Or if we did take it, it's okay because we got that nice tight risk. So you can look for opportunities that have a 10-cent risk if you want. It doesn't really matter what the specific numbers are. I just choose 30% on the 2-minute time frame for SPY specifically, but things change. The market changes. It's okay. So what we're doing is we're coming up on an opportunity right here as well. But if you look at this, this is a 20-cent box. I would need the entry here where the price currently is, and I would need the stop loss up here, and I would need that range to be no more than 20 cents. So in this case, it's pretty good size. So we could pass on that one, right? And we're above the moving average, so there's no reason to really jump into a bearish position here. We're still in the bracket as well, so it's just going to hurt people today. There's just a lot of sideways movement so far. Let's look at Tesla. So Tesla is forming a small candle. It's at the box that we're looking for rejection for that H-shaped continuation. And if this candle can stay nice and small and close in the next 2 minutes and 20 seconds, we're below the moving average. We're in the box for rejection. And if we get a nice engulf right here, that could be a nice potential bearish play. And I say potential because we don't know what's going to happen. Nobody in the market can predict things. People like to call out levels all the time. They're like, oh, it's going here, it's going there. I love it, but nobody really knows, right? So we have to separate the insight from the reality of it, right? We can call out potential levels. We can call out things where, places where the price should go. But there's never going to be a 100% guarantee. And that's why we focus on what we can control, which is our risk exposure, right? We can't control anything else. We can only control how many dollars are in the market at any given time. Unless you're caught in a halt, or then that kind of sucks. Or if something gets delisted. But yeah, and that's where this comes into play, because even if you take a super risky trade, let's say you're on a $500 portfolio and you're trading $2.50 day trade, it gets halted, and it just gets destroyed. Maybe you're 70% down on an equity trade for whatever reason. Your max loss or your max risk has only been on that $2.50 position. So it's okay. You took a high risk trade on a very small position. So it's all right. If it goes against you, that's part of the risk. You understood that before you put your money in. It's okay. There will be other trades. You can make it back. But what we don't want to do is put 80% of our portfolio into something that also has that potential. So you gotta find that proportion, right? And that's kind of why I wanted to go through that spreadsheet because that's just seeing the numbers, I think, will help, because a lot of people, you might see this $2.50 per day trade and be like, that sucks. You're never going to make any money. And that's true when it comes to only trading with $2.50 at a time. But what you're also not doing is giving a bunch of money back, right? You're not losing a bunch of money. It's all proportional to the account size, and the account is broken up based on risk, right? So we're not just traders. We have to be portfolio managers, and we have to approach this like hedge fund managers. Only you're your own client, and you want to keep you got to keep your client happy. If you had somebody else's money and you blew $400 on it on a SPY 0 day because you were hoping to make it big, you're going to have to answer to that client, and it sucks. So why would you treat yourself any differently? There's absolutely a time and a place to trade those, but it's not going to be on a small account with 80% of that account. So if you're constantly struggling, or if you're blowing your accounts up and just dumping paycheck after paycheck into the market, you can always slow down, rearrange things a little bit, reframe things, get a bigger picture view in mind, and then set out some reasonable expectations, some reasonable steps that you can follow. Then a lot of that stress will dissipate. Now, I know there's a lot of pressure, especially here in premium, to kind of offset the payment, the monthly thing. I get that. I'm not here for the paycheck, right? The majority of that money goes towards like hosting resources, advertising, stuff like that. It doesn't go right in my pocket. I don't run this place. So, we pay quite a bit of money behind the scenes to have the resources that we have. So I just want you guys to know, like, we're not trying to scam anyone. We don't really make a lot of profits here. We're here to help people. So Austin also puts a lot of the other organizations that he runs, like the recovery stuff. So it's good. That's the way we want it. We don't want this to be like a money making machine here. We make money in the market, so we want you guys to do the same. So with that said, saving money is always better than risking money in hoping, right? So if you are struggling, if you feel that pressure to, I got to pay for premium, I got to do this, I can't justify it because I'm not making money. Let's figure out why you're not making money. Let's work on a plan that helps you build into a position where you are making money, with or without the alerts. I don't care about the alerts. They have a specific win rate. They have specific criteria. It's awesome, but I understand that not everyone can follow them, and things aren't always communicated clearly. So there is obviously some things we can do on our side, and we're constantly trying to get better. And a lot of that is based on member feedback. And there's also stuff on the side of, how do we bridge that gap between somebody showing up, somebody seeing an alert, and then trying to trade it without having all the education in place first, right? So if I can't tell you how to slow down, how to, allocate your portfolio so that you're protected against your impulses, in the time it takes you to join a Discord, see an alert, and trade it, you're going to probably take a hit, and you're going to feel frustrated. So that's our challenge, right? We have to find a way to bridge that gap and fix our onboarding so that people know that it's okay to just slow down a little bit. Which is why we try to encourage people to view this more as an investment in your education than just an alert service. Because if you trade the alerts, you should be fine, right? Because they're the stuff Lee trades, there's the stuff Jay trades, it's stuff I trade, stuff Ethan trades. We don't put out alerts that we're not trading. So it doesn't mean that every trade is a winner, but it does mean that we probably have some sort of advantage over position sizing or some sort of edge, right? You got to find your edge as a trader. And we're here to help you kind of unlock that power. So if you're struggling, definitely reach out to us. And again, if you don't get the answer you want, feel free to reach out to me personally, and I'll try to help you out, or I'll find someone that can help you out. But we don't want anyone to suffer in silence, and just let us know. Devastator, I have saved so much money by taking a small loss on a predetermined stop loss. A 1% loss is still a huge win in my book. Absolutely, dude. And that's what I said last week. Is the goal when you're a new trader? They say it takes 8 to 13 times of success to develop a habit, but it might take you 1,000 tries to get to that 18 to 13. The 8th to 13th iteration of success consecutively. And that's where the challenge is, right? So if you can get 15 successful trades under your belt in a row, where you follow your trading plan and you have specific criteria in place and you execute it flawlessly and you keep that risk nice and small, regardless of the P&L, you're going to have a much better time going forward than someone who throws everything at the market and hopes, right? So getting 15 successful trades is a lot more realistic and a lot more efficient than trying to get 15 profitable consecutive trades, right? So you have to redefine what you measure success by. And when you're a new trader and you're struggling to find that consistency, it's absolutely going to be in your ability to follow a reasonable trading plan and execute it flawlessly. Because as you're developing that 8 to 13th iteration out, you're going to identify things about yourself. You're going to be like, wow, I'm really impulsive. I don't know why I did that. I broke my plan. This is why. This is exactly what I broke in my plan, because my plan has specific steps in it. So you can kind of take an active role in your own development by just trying to be consistent as much as possible and documenting things where something abnormal happened, right? If your plan is just to go to one specific stock, let's just pick a random stock here. Let's pick, let's look at Uber. I know Duck likes Uber. We'll look at Uber, okay? If your plan, let me just erase all this stuff, right? Let's say you don't know anything, okay? And your plan is just to trade engulfing candles with a specific risk of maybe 20 cents, right? And you're only looking for bullish trades because you're not on a margin account, okay? All you have to do is go to whatever time frame you like and see whichever engulfing candles fit that strategy. And that one doesn't. That one doesn't. This one, nope, doesn't. This one does. That's a beautiful one. And then if you're just trading equities on that and you're just locking profits at 2 to 1 no matter what, right? And you're just doing that over and over and over again, you're going to have wins, you're going to have losses, but ultimately you're going to have consistency. I can't really, yeah, there we go. So, I mean, that might be the only profit you get, but it's consistent, right? And it's disproportionate. And that's all we really care about. When you're starting, you have to develop that consistency before you can let those runners run and make all that huge, 4-digit % profits, right? So yeah, it's you. As humans, we have a really crappy set of default behaviors, and the market exploits that fully. That's what algos are for. They hire computer scientists, psychiatrists, neuroscience, and finance managers, obviously. And they develop these algorithms to explicitly take advantage of people's default behaviors, like impulse control, fear, FOMO, greed, risk aversion, loss aversion, diversification bias, confirmation bias, all kinds of things. And then they just manipulate the price because they have the money and they have the control. So we have to break out of that and rewrite over time our set of default behaviors so that we can identify what's allowing us to be exploited, right? Think of it like if you're a programmer and you're responsible for a website and it keeps getting hacked, right? Someone just keeps going in there and taking stuff or removing stuff off your page. Sorry. You have to figure out how they're getting in there and what you can do to prevent that, right? And that's your job. That's your responsibility to make sure that that website remains intact and then can grow, right? Your portfolio is no different. You have to figure out why and how the influence from these algos and those default behaviors is getting into your portfolio and taking money out. You have to take that step of actualization and put that boundary in place and be like, okay, I'm doing this because of this when I should be doing this, right? Regardless of the result, your job is to follow a plan, okay? And if something doesn't fit your plan, you can become aware of it. And that's your advantage over the hedge funds and over the algos and over all those new traders that lose their money. You can figure out, okay, I over allocated because, I saw a good opportunity. I wanted to build into a position that was losing and I didn't want to realize that loss. There's all kinds of reasons for doing things, but it's up to you as an individual to figure out how to identify it and how to stop it. We can obviously help with that, and that's why we give you the education. But realistically, Tesla looks like it's getting ready to potentially push up into that box again. But ultimately, it's up to you to figure out the why. We could teach you the what. Like if you come to me and say, I did this, and I'm like, okay, what's your plan? And you give me a list of steps, and I say, okay, you didn't do that, right? I could tell you the what. That's very easy, and I can give you some suggestions as to why. But ultimately, it's up to you to figure out if it's true and what the root cause is, right? I can't do that for you, unfortunately. And then once you figure out the why, then you can come back to me and say, okay, this is why I'm doing this. What can I do? And then I can give you some suggestions of things where you can work around that obstacle rather than trying to brute force your way through it, because that's where you lose money, because they account for that too. So we have to work as a team. I want everyone here to be on the same team. And that's the advantage of being in a community like this, is that we all have each other. And I'm not talking about just the staff and just the members. We all have experience in different areas of life and different areas of knowing ourselves. We've all learned ourselves at some point. So what someone does might help another person. So, but if you're just locked in a room all day with SPY and your money, SPY is going to beat you up and take it. I don't care who you are. If you're not able to follow a plan consistently and identify your areas of weakness, because it's just a cycle, right? And that's what they rely on. That's how they take everyone's money. They just wait, and it's a war of attrition. They know you're going to keep adding money into your portfolio if you keep losing, until the point where you get too frustrated and quit. So we don't want you to get to that point, because there's other ways to trade. There's other things you can look at. You don't have to just be alone in a room all day with SPY, right? We don't want you guys to go out, work, 8 hours a day, 10 hours a day, 16 hours a day sometimes, and then pay taxes on top of that, skip your lunch, all that good stuff, put a strain on your personal relationships, and then come to this place where you should already be squared away financially and put some of that money to work as passive income, and then just lose it. So if you're doing that, I want to help you restore some of that peace of mind and get some growth in your account. I don't want you guys to just keep depositing. I want you to start withdrawing. I mean, deposit too for the contribution stuff if you want, but but you get what I mean. I don't want you guys to be screwed at tax time either. If you're just trading SPY and you're just getting in and out, in and out, in and out, you're going to have a hard time at tax time, because you can't realize, or you can't claim a lot of those realized losses, but you're still responsible for the tax burden on the profits. So you have to be careful with that stuff. That's why we're introducing these more in-depth plans, or I am anyway. I think Lee considered walking through his stuff as well. I'm not sure what what his specific plan is, but this is why I wanted to break this stuff down for you guys. So it's not just, it's not just all isolated to this one box, right? Because that's really what the majority of people here are doing and focused on, which is good, because that's where you have to start. But there's so much more to the process than just speculative trades and just using 33% of your account per day, and then just using 10% of that per position, right? That's cool. That alone is a mind-blowing concept for most new traders. They don't realize they can break up their portfolios like that and have specific allocations. They just kind of buy whatever and how much ever. We've all seen it. We've seen 20 shares of this, 80 shares of that, 10 shares of this, 3 shares of that. The position sizes are just all over the place, and so are the results. So if you take a 30-year account and you split it up into 10% per position, you have specific limits in place for your losses. Your losses will never be beyond that limit that you've established yourself, right? It can't be, because you're respecting your limits at that point. But your profits have that unknown upside as long as you learn how to let things breathe over time. But until you do that, you can always cap those profits too. And as long as there's a disproportion there, you should be net profitable. And on top of that, you still have these investments that are much bigger. They're growing. They're passively reinvesting and growing with a compound curve. So it doesn't really matter how well you do for the first couple of years in the speculative department. You can just mess up royally over and over and over again, because you've got the tax advantage for the losses to offset, and you've got these compound investments reinvesting and just growing. So this is less important once you realize the rest of the process. Okay, so that's where I really want to drive home, and that's kind of why I'm doing what I'm doing. Now that's more of like a personal side project, but I wanted to help you guys by showing you that. But I'm also going to be incorporating a lot of this stuff into the live streams and education and stuff like that, because you can't just stay in this box your whole trading career. You will lose, you will wash out, and you'll join the 90% of other traders that do. So we don't want that. I want you guys here in 5 years doing this compound growth. That's what I want you guys doing. If you're just trading for fun or just to make, some gas money, that's cool too. You don't have to invest, but just realize that the odds are stacked against you if you don't have a long-term plan, and that you're not going to get any meaningful result other than coffee, gas, making a few bucks, having some fun, right? So if that's your goal, that's the expectation that you're setting and you're likely to get. And that's okay, because not everyone has the same goals. Some people enjoy working, and or if you're already financially squared away and you just don't need that much more, that's okay. You don't have to have, billions and billions of dollars to be happy in life. So it depends on what your personal goals are and your plan. But for those who are interested in long-term compound growth, you can't just stay in this box. It's going to suck. I guarantee it. And you also don't want to stay in this box with SPY and SPX and all that good stuff. If you're just trading high risk options contracts with short expirations, you might have win, 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 win. You might also have lose, 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 lose. But as soon as you take this loss and you re-enter that trade within that 30-day window, you lose the tax advantage in most cases. So why would you do that to yourself? Why would you give that money back twice? And the answer for the majority of people is they just don't know better, right? But now, rather than being caught off guard and, the whole you don't know what you don't know coming in and kicking you while you're down, you now have the advantage of knowing about it and can take a specific action to stop it. So you might lose on the trade, you might realize the loss, but you still get it back at tax time or a portion of it if it applies to you, right? Again, I can't give tax advice, but for most people that should work out, right? Because you're still, at the end of the day, no matter if you trade this or not, you're still going to have other tax burdens, right, that you have to offset. So why not give yourself an advantage there? We're stacking every other odd that we have in our favor when it comes to trading. Why sacrifice those when it comes to tax time, right? You can have an LLC, or you can have a holdings company, or you can trade in an IRA. There's all kinds of other advantages you guys can have. You just have to learn about them. And that's why we're here. We're teaching you these layer by layer so that you can build up into them. So far, we've only really covered this box, and maybe the wash sale stuff. We didn't really dig into applying it, but we did teach you about it in the PBU. But now we're digging into investments. We're digging into, we've had the wheel strategy up for a while for the advanced and lifetime members. That's more for when you get a slightly larger account above maybe 25K. And you get there through this and offsetting your capital losses. Because if you think about it, if you're making contributions, right? And this is how everything kind of impacts everything. Okay. If you're making contributions on a monthly basis, or when you get paid, or whatever your schedule is, and tax time comes around, okay, and then you get hit with let's say you got to pay like $2,000 in taxes, okay, because you couldn't, you can't write off things, you don't have an LLC, maybe you don't work from home, you don't have kids, whatever your specific circumstances are. Let's just say you end up owing $2,000. Okay, that's 4 of those contributions that you could have easily just put into here or chipped away at through capital loss offsets and not selling these shares, right? So when you don't sell these, you don't have a tax burden. You have a tax burden on the dividends, but you don't have a tax burden on the actual share sales. And then you also have it just grows. It's nice. So you're also limiting your tax burden just by breaking up this contribution every month. And then, sorry guys. And then when you get that tax bill basically saying you have to pay $2,000, you're going to kick yourself in the butt because that's 4 of these things that you could have just rinsed and repeated. That's 4 months worth of contributions right there because you didn't know enough to stay out of SPY after you took a big loss. And you could realize that loss and claim it on your taxes in most cases again, and just switch between tickers and only risk it once per month to make it meaningful. If you took a $50 loss for 12 months, it's not a lot, but it does add up. And that's, again, another contribution right there. So you're essentially putting 13 months worth of contributions in place without the $2,000 tax burden. Obviously, I was just making that up. But if you just claim the $50 losses, right? And again, that number is going to get bigger as the months go by because your contributions and percentages will grow. But you want to make sure it stays underneath that limit, or I will anyway. You guys can do whatever you want. But that's an extra month worth of contribution that you can add another 350 into your investments. You can add another 150 into your speculative trades. That's another 33% block that you get to trade with. All because you just didn't re-enter SPY after you took a loss, or SPX. Right? So it's well worth that month because you're getting that month back at the end of the year when you get your taxes back. Does that make sense? And a lot of this will be in the next episode too. I'm not trying to like pitch that, but if you guys are just interested in that stuff, I'm going to be going over that in a lot of detail. So, yeah, you can see Tesla here is just sideways. I do want to get back to the live trade stuff too. I don't want to bore you guys with the finance management. Let me catch up on chat. What if you're an introvert? That's okay. You can choose to do that on your own terms. If you're an introvert, that means that you want to be alone on your own time or your own terms, I guess. Right? The visualization really helps. Thank you. I put about 3 minutes worth of work into it, so I appreciate that. Sentinel Black, my biggest issue is I have a casino mentality. I can't break myself of. I get into it will come back, and it's what makes me lose time and time again. That is a perfect example. So when you're in those moments where you say it's going to come back, what do you think is compelling you to stay in that position or hoping that it will come back? Do you think that it's because your position size might be a little too large, or you're afraid to realize the loss? Or do you think that it's just a really good setup and it's just a wick or something? Like, what do you think is the root cause there? Or do you notice a pattern with a specific type of approach? I used to say it's a really good setup. Okay. So I have a question for you then. How many other good setups are in the market? And what do you think would help put your mind at ease? Would it help you to understand that if something is going to push and it's going to move and it's going to run and all that good stuff in a way that's meaningful, that you're going to have multiple opportunities to get in? Or do you feel like you're in that mindset where it's just a make or break? If I don't get in at the absolute bottom, that's it. Yeah, I missed the whole run, because that's something we see a lot too. There's always opportunities to get in without chasing. The explanation of the wedge just changed your life. That's good. It's that's all the stock market is, just supply and demand, and that's really what you're doing too with your trading. Is you're just doing your own form of supply and demand. So it's good that helps. That's all. I want to see those little aha moments, because every time somebody makes they clear a milestone, it just changes their trading, and it's nice. So the more of those we see, the happier we get. That's the it's our Christmas morning. Okay, Devastator says, I find it really helps to have different accounts and different brokers for different things. Absolutely, dude. That's perfect. You can take that $500 amount and you can make a scheduled deposit, $350 into one account, $150 into another account, and be set. And it'll just keep doing it automatically for you. Where it's 2023, we can automate everything almost. And then if you just want to have investments and you just want to have that portfolio over there, you can. And if you just want to trade speculatively, let's say you want a cash account and a margin account. If you want a margin account for your growth stuff, your wheel trades, things like that, that's good. Let's say you want to take advantage of some sort of tax. Some sort of savings thing, right? And let's say the broker is going to pay you 4% just for having cash in the account. You could do that. That's guaranteed money. Why not? There's a lot of other types of investment. Like yesterday, I've talked briefly about taking out life insurance, and then you use the payout for that life insurance policy as collateralized debt. And then that debt is tax-free, and you can use that to speed up the dividend process. But obviously you have to be financially responsible first, and don't just do that without understanding the different types of insurance policy and loans and all that good stuff. So there's a little more that goes into it, but that's the basic strategy. There's people that just do that. There's real estate, there's startup businesses, turnkeys. You could be an angel investor. There's all kinds of different ways to diversify your passive income without having to look at SPY 1 minute time frame. You're going to have much better success growing an account with consistent contributions, a comprehensive plan, and limiting your risk exposure on your own trades, if that makes sense. Because when we're new, we're just kind of stumbling around. We're trying to figure things out. That's not when you want to lose the bulk of your capital. I guarantee it. It sucks. It hurts. So best thing we can do is stay small, practice what we can't trade what we can trade safely, and just have that passive income sitting in the background, just waiting. If I told you today you could have 6 figures if you started 5 or 10 years ago, back in time, and then send you back in time, would you start doing that today? Or I guess then would be today. It's confusing. It's very, very philosophical. So why not start today? And then when we have this conversation 5 years from now, I don't have to ask that question. What do you think is getting in the way of you guys starting this longer term plan? Is it the account size? Because I'm doing this on a $500 account. Boop. And I feel like a lot of people could probably scrape up $500 within a couple of months to a year. Even if you don't start today. And I'm not saying you have to contribute $500 a month, because that is pretty steep for a lot of people. I get that. I live in New York. I know the economy sucks. What if it's only $25? What if it's only $20? Right? It still adds up. It still compounds. It's still money that you're not throwing at SPY. Also. And I'm just picking on SPY because that's where most people lose their money. I'm not trying to call out anyone in here specifically, because I mess up on SPY all the time. It's okay. But I keep those losses limited to this small account because I don't care. Because I get it back at tax time. So I don't have to worry about it. Let me catch up on the chat here. Stickman. I'm not that much of an introvert, but yeah, I'm really glad you're doing the rags to riches on YouTube. I've just got to divide that by 5. That's, do what you can, man. I just want to get people out of this specific box, because this is where people kind of need to spend time, but it's also a place where you kind of get hurt, right? So you want to stay in there enough to learn, and then get out, right? You want to move to a bigger pond. Okay, SPY here. I'm sorry. I keep leaving SPY off for you guys. I'm sorry. So yeah, if we're looking for a bearish thing, this ain't it. We're starting to break out above the bracket here, the closing bracket. So this is where we'd look for bullish trades. This is where we'd look for bearish trades. Anything in here is just a channel, right? So if you're looking for Bearish trades, it'll be off this resistance. If you're looking for bullish trades, it'll be above this support or above this level here with a good confirmation or BAC. Bearish trades again are here or below this bracket right here in most cases. Okay, so let me just get back to the chat here. Devastator says Robinhood pays more than a checking account. Absolutely. That's one of the best decisions they've made. I hate the company. I hate the way they're run. I hate the platform, but that is one of the best things they've decided to do. And a lot of their profit margins come from the way that they execute orders, because they broker match first and then they send it to the market. So they get insane, insane profits. So it's good that they're actually starting to reinvest that into their customers. So that's good stuff. And they're also taking that money and spending it and using it in, money markets and stuff like that. So they make plenty. We make plenty. It's all good. Stickman, where's the time machine? I'm building it. It's going to take about 5 years. So I just go ahead and start now, buddy. Snowflake, I set my daughter up a Robinhood account to put her savings in. A couple dividend stocks that are in 4.9% interest. It's green every day. That's amazing. That's the way to go, man. Now, it's not going to be green every single day for 5 years because the market might change a little bit. But what you're doing is you're setting yourself up for long-term passive growth that you don't have to actively manage, that you can contribute to. And then anything on top of that, you can trim those profits and put them into that to speed it up. But you're not going to take money out of that to slow it down. That's amazing, dude. Good stuff. Is that for college or is that just for just so she has it? I don't want to get in your personal finances and stuff, but but I just want to make sure you have a good reason. You can always DM me if you want. Yeah, Jay loves it too. We all do. Everyone who's made it and figured it out, we love that stuff because it means that you're about to turn that corner and treat it like a business rather than just a hobby, Sentinel Black says, I'm still working on the basics. I feel I need to know a little bit more before I can manage this system. Perfect. If you have questions, we're always happy to help, but not knowing things means there's an opportunity to learn. So that's awesome. If you want, I'll put this screenshot in here. And I'm not saying that you guys have to follow this exact plan because, you got to make your own plan. But it's a good template. So if you have any questions about any of these steps, you're always free to ask questions. I'm just going to minimize that so we have SPY and stuff up here in the background because people like that. But yeah, that's your advantage as a new trader is you just don't know everything. I don't know everything. I'm still learning. I still try to learn something new every day, even if it's just a broker feature or something that I don't use. But yeah, learn away, man. That's where it's at. Don't focus solely on speculative trading because that's going to hurt you more than anything. Snowflake says, anyone could do that and paper trade for a couple of years. Absolutely. And that's the whole point, right? If you view this as an investment in your education and you save and invest in dividends and passive income, you will have money over time, right? You're not going to go broke by saving money and putting it into passive growth. It's just slow. It's a little bit slow depending on how the contributions shake out, but it's still relative to your budget. And that's the cool part. If you're on a smaller budget and you can't afford a lot and you can only save maybe 20 or 25 bucks a month, that means that you're not in a position to try to outperform someone on a bigger budget, right? So that $20, $25 contribution might save up to $300 a year. That's $300 you didn't have before. Plus you got dividends rolling in on top of that now. So if you put that 25 bucks into the market every month and blow it, every month you got to start over. There's no dividends. There's no passive growth. There's nothing. So you can start amassing that, and then you'll have more than $25 to trade with. If you put 20 bucks in, you'd say you put 15 bucks into savings and 5 bucks into speculative trades, right? A couple months go by, you probably won't have anything that you can really trade with. But you can always paper trade for those first couple of months. You can, you can keep your position sizes nice and small, but either way, you're going to have those passive income elements just growing over time. And that 15, 20 bucks, the 20 bucks a month, which might result in only having $5 to speculatively trade at month 4, that's 20 bucks a month. At the end of a year, that's That's $60 a month that you can trade with. And, 3 times at $180 in your dividends, your investments. And at that point, it starts to compound because you're able to buy more shares with those dividends. So you just got to start somewhere, right? It doesn't matter if you're able to afford $500 a month. Some of you guys can afford like 10 grand a month. That's okay. That's kind of what I do on my bigger accounts. I just keep contributing. But ultimately, it's up to you to determine what's appropriate for your budget and to not introduce yourself to that cognitive bias, cognitive dissonance, and be like, I want my account to be there by X date, because it's going to hurt you when you can't meet that expectation. So it's you got to find a way to develop your own plan and stick to it, right? And it shouldn't involve putting 90% of it into risky trades. Duco, my biggest loss is SPY by about 4 times my next highest loss. That right there is a very common symptom, man. And that's rough. And that's why that SPY can get you, man. It sneaks up on you. Now, if you took that number that you're red on SPY and you added it to your portfolio value, would that give you an ulcer? Or would you want to go back in time and undo that? And more importantly, are you going to make sure that you're doing something today and every day going forward to make sure that that number doesn't grow exponentially? And if so, what specifically would you do? Do you still want to trade SPY? If you do, what are you going to do to protect yourself? So let's have that talk at some point. SPY is most newer traders, when they get into options, it's most of everyone's biggest loss, probably for the first year, at least, because they just kind of keep going back to it. Now that you know that not only can you claim a loss on your taxes, again, just generic education here, I can't give you good advice, but now that you know that most people can claim a realized capital loss, and that you have a 30-day timeout on that before you can re-enter that stock and wash sale it, and the fact that you can roll those, right? You can introduce up to like 5 tickers if you wanted, or 10 tickers even, and just rotate through those a couple of months, and you get the profits from the winners and you get the tax advantage from the losers, as long as you manage those tickers effectively and pick those top-notch setups with minimal risk, right? Because if you do lose, it's okay. Because A, you kind of get it back at tax time, but B, the likelihood of you losing should be lower because you're picking the best possible setups because you're forced to trade less. Now, it doesn't mean you want to hold it and, kind of force it into profit, because that's influence. It's outside bias affecting your trade, and you're trading the profit at that point, not the trade. But if you trade the trade and you can figure out how to do that consistently, the profits will take care of themselves and you get the tax advantages. So let's work on that. Let's diversify our losses as well, not just our profits. Stickman, procrastinating is a bit of a problem on my end, but of course, lack of funds. Okay, so we know for a fact we can fix the lack of funds. Right? Can you afford $20 a month? And do you think that'll make any kind of impact over 5 years? If you're only putting in $20, you might not be able to do anything for a couple of months. And you just have to understand that's part of the process sometimes, especially if you're on a smaller budget. But it's okay, right? We got to start somewhere. Sentinel Black, I have been trading for a year in the dark, just going based on my perception of what is happening with the trend line, only trading long. I've made quite a bit, but I need to learn why the charts move the way they do. Yeah, so it sounds like you probably have, you probably understand something about the market. Maybe it's just something you can't articulate. So I feel like if you're exposed to the education a little more, you'll probably be able to identify things that really resonate with you. And that's probably what you're seeing. Like maybe it's engulfing candles, maybe it's BACs, maybe it's a trend line break, maybe it's a volume disparity, right? Maybe it could be any number of things. Could be higher highs, higher lows, lower highs. Could be any of that stuff. Maybe it's just a matter of clicking it and putting a name on it for you. But if you're making quite a bit, that's awesome. You're just looking to optimize at that point, which is cool. So if what you're doing is working, work it, all right, let me catch up on the chat. Snowflake, she's in college. Okay, cool. That's awesome, dude. That's a that's the best possible time to start saving, because most college kids don't have that opportunity. Eating ramen. Jay, love how you refer to it as a business. Trading is literally checking first, where will I do business, which is support and resistance and having a plan. And then playing 1 minute SPY stuff is not proper business. No, that is a great way to go out of business. Now, there's a time and a place for it for sure, if that is something you're comfortable with. But that's not where you're going to make your profits, guys, or your wealth. You're not going to make wealth there. There's no trader on this planet that has made it into the 7-figure realm without already having a bunch of money and guessing has made it with SPY on the 1 minute or the 5 minute or 2 minute or 3 minute. It's always passive income behind the scenes that you don't see and compounding reinvestment. So, and multiple avenues of revenue. So don't let anyone fool you. You're not going to make your millions on SPY on the 1 minute. And if you do, you're not going to keep it. That's a hard talk to have sometimes, but I want you guys to succeed. So Snowflake, she actually saved up 10K last year, so I made her put 30% in IRA. Got the Robinhood Gold, so she got 3% match on IRA and 4.9% settled funds in her trading account. That's awesome, dude. Super proud of her and doing my best to keep her killing it. That's amazing. And what she's doing is she's not actively trading. Like, she's not putting that at risk, just trying to figure stuff out. So she saved up her hard-earned money. She put it into 2 avenues of defined returns, roughly defined returns. Obviously, IRAs can fluctuate. And she will have tax advantages from both of those. In most cases, IRAs obviously have some tax advantages. Robinhood payouts probably have their own little tax implications, but I'm sure there's a little burden. But it's okay. It's settled funds, and it's not something that she's exposing to risk and potentially losing to outperform those passive profits. And if she wants to, on top of that, she can always just, if she ever wants to learn how to trade, or any of you guys ever want to learn how to trade, you can paper trade, you can mark your charts and practice, or you can just do the good old-fashioned toss a couple hundred into another small account and just practice with real money, if that's something that you feel like you need to have skin in the game. But either way, the bulk of that money is sitting in passive growth, and that's where she's going to find success long-term. So I'm proud of her, too, for doing that. That's good stuff. Anyone who does that stuff. Stickman says, well, as I mentioned, I'd have to divide the 500 by 5 or 100. Okay, so dude, honestly, $100 per month for dividends is awesome when you're on a smaller budget. So as long as you're squared away financially and you can afford to not see that money for a year. And I'm not saying that you can't sell them within a year, but if you do, you kind of lose the long-term capital gains tax stuff. And there are certain dividend stocks, for example, that you want to just buy and sell. You want to buy before the ex-dividend date and then sell. So you get the payout. But in those cases, you have to make sure that the price difference between your buy and sell doesn't exceed the dividend at that point, because then you have the dividend payout, plus you have the tax burden of short-term capital gains or loss that you can claim or you're responsible for. So a little bit rough there when it comes to the short-term stuff. But if you're just adding $100 in once a month, that's $1,200 at the end of the year that you didn't start with. And you can do a lot with $1,200 for dividends. And that's definitely in the realm of reinvestment. So it's good stuff. I don't care if it's $50. It's something that you're able to start with, right? Do you think you'd perform better if you put $100 a month into that, or $100 a month into options, day trades, and low float runners and momentum breakouts and stuff like that? Or do you think there's a happy ground if you are successful with those? Do you think it might be worth it to split that money up a little bit and use some for investment and some for speculative trades? Still paper trading. Okay, that's good. You're eliminating your risk exposure by not putting anything at risk. That's awesome. So 100% of those contributions can go towards compound reinvestment. And then when you're ready to stop paper trading, you can always dial it back and mix those up. But you'll have a much bigger head start. That's pretty good stuff, man. And that's something like I want to just ask everybody everybody who's here, if you were given 5 trades in a row with 1 share, would you be able to do those successfully and consistently? I don't care about a profit. I care about, would you be able to follow your plan 100% of the way through on all 5 of those trades with 1 share? And given that your plan is supposed to be disproportionately net profitable, do you think that would result in a net profit, assuming all the things were the same size? If you're not sure, you can always try it out. Right? Well, actually, yeah, I just realized it's 11 o'clock. Let me end the recording because there are people that are going to watch this at like nighttime after work, and it's going to be a super long stream. So it's an hour and a half. Let me end the recording, and then we'll just continue in Discord for a little bit, and then I got to jump off.